In the year 2000, the three biggest companies were Cisco, Intel, and Nokia. And yet, 25 years later, Intel is only ranked 180th globally, whereas Nokia has plummeted all the way to 900th. But here's the part that should terrify you, or excite you depending on how you look at it. They had every opportunity to compete with the companies that replaced them. Intel could have been Nvidia. Nokia could have been Apple. They saw the future company and they still lost the race. So what separated the winners from the losers? Well, we found four specific traits: massive addressable markets, platform economics, network effects, and positioning at the exact moment that an industry transforms. Now, 10 years from now, you're either going to own these stocks or you're going to wish you had. So I'm here to make sure you're in the first group by digging deep to find those best long-term winners. By the way, I'm Steve Reitmeister. I was editor-in-chief at Zacks.com for over a decade, and I'm currently a partner at WallStreetZen.com. And if you want stock picks backed by real quantitative analysis instead of whatever's trending on social media, hit that like button right now. It helps YouTube know to show this video to more investors like yourself. Okay, let's jump right in with stock number 5 today, which is LiveRamp with a symbol of ARMP. Here's what most investors miss about LiveRamp. They are not just a marketing data company anymore. In early January 2025, they transformed their entire data marketplace into an AI-focused hub. What the heck does that mean? It means they're becoming the infrastructure that connects companies that need data to train AI models with the companies that have that data. Think about the AI revolution happening right now. Every company wants to build AI applications, but they all have hit the same wall. They need massive amounts of high-quality, permission data to train their models. LiveRamp is building the pipes that connect these two worlds. They're not building the AI in themselves. Instead, they are becoming the essential infrastructure that AI runs on. This no doubt explains why Wall Street analysts have an average price target on Ramp suggesting 55% upside from current levels, whereas the street high price target would represent about a 70% gain. In terms of its Zen rating, Ramp ranks in the top 1% of more than 4,600 stocks we track. That's an A rating, which equates to a strong buy. It's also ranked as the number one stock in the attractive software infrastructure industry, meaning right industry, right stock. Revenue growth over the past 3 years has been stellar at 71%, easily placing Ramp in the top 7% for the growth component grade. But here's what really caught my attention: significant insider buying. When executives are putting their own money into the stock at these levels, that's usually a very good sign of what lies ahead. The company's AI factor rating in our system also scores an A. This means that our in-house neural network, trained on more than 2 decades of market data, the company's AI factor rating in our system also scores an A. This means that our in-house neural network, trained on more than 2 decades of market data, has singled out Ramp as a likely outperformer. LiveRamp is not just talking about AI, they're actively positioning themselves as the data infrastructure layer for entire AI ecosystems. As more companies realize they need governed, permissioned access to training data, LiveRamp's platform becomes more and more valuable. The risk: the momentum rating here is a D. The market hasn't fully recognized this pivot yet in their business model, but that's appealing to a contrarian like myself who realizes the market is often wrong, which begets outsized opportunities. And yeah, competition exists, though not many companies have LiveRamp's scale in identity resolution and data connectivity. But all these caveats might just be a blessing in disguise. Right now, Ramp is trading at a very attractive PEG ratio under 0.5. Anything under 1 is a beautiful thing to behold. This is no doubt one of the reasons why their value component grade is in the top 6% of all stocks analyzed. Here's my take: this is exactly when you want to buy platform infrastructure plays, before everyone else figures it out. The company has the relationships, the technology, and now they're positioned at the intersection of two of the biggest trends in tech: AI and data privacy. With analysts seeing 55 to 70% upside and insiders buying, the setup is very, very compelling. Okay, let's move on to stock number 4, which is Oppfi with a symbol of OPFI. This stock is trading under 15. Here's the setup. There are about 60 million Americans who are underbanked and are credit insecure. That's roughly 18% of the U.S. population. These are people who can't get loans from traditional banks because their credit scores are too low. So what do they do when they need money? They turn to payday lenders charging predatory rates, or worse, They just don't have access to credit at all. Oppfi built an AI-powered platform that uses machine learning to serve these customers responsibly. They're not lending their own money. They partner with banks who originate the loans, while Oppfi provides the platform, the underwriting, and the servicing. The business model creates incredible economics. In the most recent quarter, their loan auto approval rate hit 76% just a year ago. That's their AI system getting smarter. That may not sound that special, but is a nearly unheard of score for a subprime lender. They're also expanding beyond consumer lending into small business credit. In fact, they're launching a new AI tool called Lola that's expected to further automate approvals and reduce costs. Like our previous pick, Oppfi also ranks in the top 1% of stocks in terms of Zen ratings, and it's ranked number 1 in the credit service industry. When you look at the component grades, this thing scores A for growth and A for financials. That combination is rare because most fast-growing companies are burning cash to fuel that growth. Yet Oppfi is growing rapidly while maintaining fortress-level financial strength. The momentum rating is a D because the stock price has been under pressure, and this is a subprime lender, which means there's credit risk involved. Economic downturns could definitely increase default rates, and competition in fintech is downright brutal. But here's the key fact: 60 million underbanked Americans. Oppfi is currently serving only 200,000 of them. That's a massive runway to growth. The company is already profitable, growing fast, and trading at a valuation that doesn't reflect those positives. They're building the AI-powered lending platform for a market that traditional banks won't touch. The upside potential is truly vast, as is the investment opportunity. Okay, moving on to stock number 3 on my list, which is Rush Street Interactive with a symbol of RSI. Online sports betting and iGaming, that's the online casino gaming, is being legalized state by state across America. We're in the early innings of what could be a massive $100 billion market, and Rush Street Interactive is positioned to be one of the big winners. They operate RushBet, PlaySugarHouse.com, and BetRivers.com. They're already live in multiple U.S. states and in Latin America. But here's what makes them different from DraftKings or FanDuel. They're actually profitable. They're not spending blindly on customer acquisition. They're building sustainably. Now, let's talk about that growth. Revenue hit $1.1 billion, up more than 20% year over year. Even better is their 3-year compounded annual growth rate above 90%. This is a rocket ship that's just starting to take off because new states keep legalizing online gambling. But here's what really jumps out from the profitability metrics. Return on equity is now almost 30%. Return on assets is about 6%. For a company growing this fast, to already be profitable is very rare. Earnings of the past 5 years have grown more than 70% annually. That's not a typo. This tells us the company is scaling profitably. When it comes to the Zen ratings, RSI ranks in the top 4% of all stocks that we track. It's also ranked number 1 in the attractive gambling industry. Never a bad idea to go for the best stock in a growing industry. Wall Street also sees the opportunity given that the average analyst price target is 23. That's more than 30% upside from current levels, but the street high target is 27, implying 50% upside. Honestly, I think those targets may prove to be conservative given how many states and countries still haven't legalized online gambling. Here's the real kicker. Insiders have been buying aggressively. The CEO, the CFO, the COO, and other executives have been buying millions of dollars worth of shares in the open market. In early January 2026, the CEO bought almost $900,000 worth at these levels. When you see coordinated insider buying like that from the entire C-suite, you are wise to pay attention. Now, the risk competition is intense. DraftKings and FanDuel have more marketing muscle. The momentum rating is only a C, as is the safety rating, which is a tad underwhelming. But this is a volatile stock in a competitive industry. But the fundamentals are there. The growth is there. The profitability is there. And management is putting their own money where their mouth is. This isn't a speculative bet on legalization. It's a profitable business ready for even more growth in the years ahead. That's why it's on the stock list today. If you're getting value from this breakdown, do me a favor, go ahead and hit that subscribe button. I put out stock analysis like this on a regular basis, and this is the best way to get notified when the new videos go live. All right, back to the stock picks with number 2 in Ooma with a symbol of OOMA. Here's the favorable setup. There are about 33 million small and medium-sized businesses in the United States. The vast majority are still using traditional landline phone systems that cost $40 to $50 per line per month, with zero flexibility and zero integration with modern business tools. Ooma built a cloud communications platform that replaces all of that for just about $20 per user per month, with over 100 built-in features that would cost a lot extra on any other system. But here's what makes this an exciting platform play. Once a business moves to Ooma, the switching costs to go elsewhere are massive. You're talking about porting phone numbers, training employees, integrating with CRM systems, setting up call flows and virtual receptions. This creates incredible customer retention. And every business that joins the platform makes it more valuable because they're building data on optimal call routing, integration patterns, and usage behavior that improves the product for everyone. Revenue over the past 3 years has grown over 60%. They're not just adding customers, they're also expanding within existing accounts. Small businesses start with the basic phone service, then add video conferencing through Ooma Meetings, then integrate with their CRM, then upgrade to Pro Plus for advanced features like call queuing and hot desking, etc. That's classic platform economics, land and expand. The model is almost entirely subscription revenue, so it's predictable and recurring. They're also not spending billions on customer acquisition like traditional telecom companies. They're growing through word of mouth and strategic partnerships with IT service providers who recommend Ooma to their clients. Once again, the Zen Ratings puts this stock in the top 1% based upon 115 fundamental factors. It's also the number one ranked stock in the telecom industry out of 57 possible companies. Now, look at the component grades. This thing scores an A for growth, an A for financial, and A for AI factors. That specific triple combination is extremely rare. Most fast-growing companies are burning cash to fuel expansion. Ooma is growing rapidly while maintaining strong profitability. Now, Wall Street analysts also see the opportunity. The average analyst price target points to more than 60% upside from current levels, whereas the street high target is closer to 75% upside. The risks: the momentum rate is a C. The market hasn't recognized this platform story yet. The stock has been under pressure despite these strong fundamentals. Competition exists from RingCentral, Vonage, and others in the space, and they're a smaller company competing in a market with much larger players. But here's my take. This is exactly the kind of platform company that becomes obvious in hindsight. Cloud communications for small and medium-sized businesses is a $100 billion market opportunity that's still very fragmented. The market is treating this like a commodity telecom business. It's not. It's a SaaS platform with network effects, recurring revenue, and a massive runway of small and medium-sized businesses that are still wasting money on antiquated landlines. And finally, my number one stock is Criteo, with a symbol of CRTO. Criteo used to be known as a retargeting ad company, like when you look at shoes online and then those shoes follow you all around the internet. The business was fine, but it wasn't a platform. It wasn't a network effect. It was just another in a long line of ad tech companies. But something changed. They've pivoted hard into what they're calling agentic advertising and AI-powered shopping integration. What the heck does that mean? They're building AI agents that can autonomously optimize ad spending across thousands of retailers and publishers in real time, not just showing ads, but actually driving sales. Earnings growth is on fire, 70% the past year, 120% over the past 3 years. This is not a struggling legacy business. This is a company that's figured out how to reinvent itself and already showing the gains in the bottom line. Not surprisingly, the Zen Ratings is picking up on the fundamental excellence happening at Criteo. Not only an A rating, but in the top 4% of all 4,600 stocks we analyze. Now, here's what gets interesting when we dial into those fundamentals. The value rating is off the charts. In this category, it ranks in the top 1% of all stocks. The stock is trading a price to earnings ratio that's absurdly cheap for a company that's growing and pivoting into AI. The PEG ratio, which also measures the PE relative to the growth rate, is also incredibly attractive. Wall Street gets it too. The average analyst has a 12-month target price that stands around 36, nearly double the current level. Insiders are buying too. When you see insider purchases in a company going through a strategic pivot like this, it tells you management believes the market is missing something and they want to cash in. So do we. The risks: they're competing with Google, Meta, and Amazon advertising. That's a bit of a David versus Goliath territory. The momentum rating is only a D. The stock has been beat up, yet that's part of the upside opportunity when other investors wake up. But Criteo has something their competitors don't: direct relationships with thousands of retailers. That's their economic moat, and that's the network effect that could turn this into a much, much bigger platform opportunity. While everyone else is buying the mega cap ad platforms, Criteo is quietly building the AI infrastructure for e-commerce advertising. And they're positioned right at the intersection of AI and e-commerce, two of the biggest growth trends in technology. The 100% upside to analyst price targets, well, that's the beginning of the story if this pivot in the business really pays off. How do we find these five stocks today? Let me walk you through the methodology because I want you to understand this isn't just guesswork. We use the Zen rating system, which is an AI-driven quantitative model that analyzes 115 factors across every stock. That includes 26 financial health metrics, 22 growth factors, 21 valuation measures, plus momentum, sentiment, safety, and AI-specific factors. A true 360-degree review of a stock's attractiveness. Even better, it is predictive about the future, meaning that our A-rated stocks typically outperform the market. This shows up loud and clear in our average annual return of 32.5% since 2003. Please compare that to the 10.8% return for the S&P 500 over 2 decades. That is a life-changing difference. But we didn't just look for A-rated stocks. We looked for companies with specific characteristics, industry leadership, strong fundamentals, positioned at major market inflections. You can see all the Zen ratings for free on WallStreetZen.com. Just go to any quote page to see it posted there. The premium features that let you screen for A-rated stocks, track insider buying, and see daily ratings updates, those are what we use to find special opportunities like these before they become obvious to everyone else. We use a similar methodology to identify 3 stocks that could double or more in 2026. If you'd like to check out those 3 stocks, I'll put a link to that free report that covers them down in the description, or scan the QR code right here. Okay. Will all 5 of these stocks work out? No. Remember what happened to Intel and Nokia. They had every advantage, resources, technology, market position, but they missed the platform shift. They didn't recognize that the future wasn't just about hardware commodities, it was about ecosystems. However, I strongly sense that these 5 companies have what it takes to continue their revolutionary path that leads to tremendous growth and delivers outside gains to investors. Maybe not all 5, but enough of them should outperform to make it worthwhile. In the comments section down below, and let me know which one of these tickers you like the most. Which one of these stocks do you think are best positioned to thrive in the next 10 years? And if you want more analysis like this, then click the video that's popping up right now. I break down 3 under-the-radar stocks that have recently received strong buy ratings from top Wall Street analysts.